Welcome to the Texas Home Loan Hustle, where we keep it real about mortgages, real estate, and everything going on here in Texas. And if you're not in Texas, that's completely okay, because most of what I talk about applies nationwide. Today, we're continuing the conversation about collections, charge-offs, and how they affect your ability to qualify for a mortgage. This is one of the biggest issues I see when working with home buyers, whether you're applying for FHA conventional DSCR bank statement, profit and loss statement, or other non-QM loans. It is extremely important to understand your credit profile before applying for a mortgage. And I want to stress something. Your credit score is important, but your credit profile matters just as much. A lot of buyers skip this step. The first thing they do is call a realtor, start looking at homes, and fall in love with properties before they even know what's sitting on their credit report. The very first thing you should do is pull your credit report. You have the right to access your free credit report through annualcreditreport.com. Please do not rely only on Credit Karma. Credit Karma gives what's considered more of a retail score. Mortgage lenders use a different scoring model. Mortgage scores are calculated differently than credit card or retail lending scores. That's why I always recommend pulling reports directly from Experian, Equifax, TransUnion. Now let's talk about why credit profile matters. There's a major difference between someone with a 590 score because of medical collections versus someone with a 590 score because of multiple charge-offs, repossessions, and unpaid revolving debt. Underwriters look at patterns. What lenders actually care about when they start reviewing collections and charge-offs is not just whether you have them. They look at how many accounts are in collections, how many charge-offs you have, what type of collections they are, whether they are recent or old, and whether you've reestablished positive credit afterward. That's what's called your credit profile. As a former underwriter, I can tell you, underwriters are trying to determine one thing. Are you financially stable today? When underwriters review your file, they're looking for signs that you've recovered financially. They want to see stability, consistency, reestablished payment history, savings reserves, and responsible financial behavior over time. Now, if you have a large amount of collections and charge-offs, usually your score is already going to reflect that. But the concern isn't always just the score. The concern becomes, has this borrower demonstrated financial recovery? That's why it's so important to pull your credit report and actually review it carefully. Now here's something many people overlook. Reserves. If you have credit challenges but can show savings, retirement accounts, emergency funds, or several months of mortgage reserves, it can significantly strengthen your file. I had a client whose credit wasn't perfect, but she had substantial reserves inside her retirement account. A lot of her collections were medical related, and the lender could clearly see she had financial backing and stability if an emergency happened. That matters. This is why mortgage preparation is so much deeper than simply saying, "What's my credit score?" What I want to drill in here is that your entire financial profile matters. You should be checking your credit and partnering with the right legit licensed individuals to help with ways to improve your credit profile. Understanding your consumer rights and making sure your credit report is accurate and valid are important steps. At Pointers Financial Services, we offer free tools through Pointers Budget Wise to help clients better understand their financial positioning before they apply for a mortgage. Pointers Budget Wise was built for educational and financial guidance purposes. The platform does not guarantee lending approval or loan qualification. Instead, it's designed to help users become more financially organized and better prepared before entering the mortgage process. When you sign up, you complete a quick questionnaire so the system can better understand your financial profile. Self-employed, W-2 employee, independent contractor, or a combination of income sources. Based on your responses, the platform helps create a personalized financial readiness profile to help you understand where you currently stand. The best part is, access to the educational platform is completely free. You only pay if and when you decide you're ready to move forward with a mortgage application and authorize a hard credit pull through us as your lender. Inside the platform, users have access to credit and debt validation letter templates, collection tracking tools, financial organization resources, mortgage readiness, education, credit positioning guidance, and direct messaging support where you can send questions to our team. The goal is simple: to help people become informed, organized, and better prepared before applying for a mortgage. And for self-employed borrowers, we've partnered with Hive Taxbook, a centralized self-employed financial intelligence platform designed specifically for entrepreneurs, independent contractors, business owners, and self-employed homebuyers. Personally, I use Hive Taxbook for far more than just business credit building. What makes the platform powerful is that it combines multiple financial systems into one place for self-employed individuals who often struggle to find tools truly built for the way they earn income. Hive Taxbook provides tax strategy tools, mortgage readiness, education, business operations, support, contractor management systems, financial planning resources, and operational tools designed specifically for self-employed business owners. For self-employed borrowers looking to purchase a home, it becomes an all-in-one financial organization and readiness platform. The system was built by accountants and mortgage professionals who understand the unique challenges self-employed borrowers face when trying to qualify for financing. The goal is to help users better understand financial readiness, credit positioning, debt structure, income analysis, tax positioning, and overall mortgage preparedness. Because for self-employed borrowers, qualifying for a home is often less about how much money you make, and more about how your financial profile is structured and presented. Thank you for sticking around. If you found this video useful, please hit the like button and share. Stay tuned because we're going to continue diving deeper into mortgage readiness, credit profiles, and what lenders are truly looking for behind the scenes.